When was the last time you actually withdrew profits from your trading account? Livermore said that's the only money that counts. Everything else is just numbers on a screen. He wrote,
"The only money that is ever taken out of Wall Street by speculators is the money they draw out of their accounts after closing a successful deal."
Most traders never withdraw. They let profits sit in the account, roll them into the next trade, and eventually give it all back. Livermore made this mistake too, even after making millions.
"I never have been able to make $1 outside of Wall Street, but I have lost many millions of dollars which I had taken from Wall Street, investing in other ventures."
The lesson wasn't about bad investments. It was about what he failed to do with his profits while he had them. Here's Livermore's rule for keeping the money you make, because making it means nothing if you can't hold on to it. Livermore's rule was specific.
Here is another little point that might well be remembered. A speculator should make it a rule each time he closes out a successful deal to take 1/2 of his profits and lock this sum up in a safe deposit box.
Half. Every time. Locked away where you can't touch it. For futures traders, that payout from your prop firm or that withdrawal from your funded account, that's the only money that counts. Everything else is just numbers on a screen until you convert it to cash. This is Chapter 4 of our breakdown of Jesse Livermore's book, How to Trade in Stocks. Everything comes directly from his writing. His own words, his own wins, his own losses applied to modern futures trading. Chapter 1 was about patience. Chapter 2 was about recognizing danger signals. Chapter 3 was about focus. Chapter 4 is about keeping your profits, because making money means nothing if you give it all back. Livermore opened this chapter with a warning he'd given before, but repeated because it matters that much.
"I have warned against averaging losses. That is a most common practice."
Then he walked through exactly how this destroys accounts.
"Great numbers of people will buy a stock, let us say at 50, and 2 or 3 days later, if they can buy it at 47, they are seized with the urge to average down by buying another 100 shares, making a price of 48.5 on all. Having bought at 50 and being concerned over a 3-point loss on 100 shares, what rhyme or reason is there in adding another 100 shares and having the double worry when the price hits 44?
You're already wrong. Now you're doubling your exposure to being wrong. He pushed the logic further.
If one is to apply such an unsound principle, he should keep on averaging by buying 200 shares at 44, then 400 at 41, 800 at 38, 1,600 at 35, 3,200 at 32, 6,400 at 29, and so on. How many speculators could stand such pressure?
The math becomes absurd fast. But that's exactly what averaging down leads to if you follow the logic. His conclusion.
So, at the risk of repetition and preaching, let me urge you to avoid averaging down.
For futures traders, if your ES long is underwater, adding contracts doesn't fix your thesis. It just increases your exposure to a trade that's already proving you wrong. Livermore had one rule about margin calls.
"I know but one sure tip from a broker. It is your margin call. When it reaches you, close your account. You are on the wrong side of the market."
A margin call isn't bad luck. It's the market telling you that you're wrong and refusing to accept it. He continued,
"Why send good money after bad? Keep that good money for another day. Risk it on something more attractive than an obviously losing deal."
For prop traders, if you're approaching max drawdown, that's your margin call. The account is telling you to stop. Don't add size hoping to recover. Step away and preserve what's left. For traders using their own capital, the same principle applies. Don't fund a losing position with fresh capital. close it and wait for a better setup. Livermore identified the psychological trap that destroys most speculators.
One major mistake of all speculators is the urge to enrich themselves in too short a time. Instead of taking 2 or 3 years to make 500% on their capital, they try to do it in 2 or 3 months.
And sometimes they succeed. But then what happens?
Now and then they succeed. But do such daring traders keep it? They do not. Why? Because it is unhealthy money, rolling in rapidly and stopping for but a short visit.
Fast money doesn't stay. It creates overconfidence that leads to blown accounts.
The speculator in such instances loses his sense of balance. He says, "If I can make 500% on my capital in 2 months, think what I will do in the next 2. I will make a fortune."
That's the voice in your head after a big win. And it's the setup for disaster.
Such speculators are never satisfied. They continue to shoot the works until somewhere a cog slips, something happens, something drastic, unforeseen, and devastating.
For futures traders, if you pass an evaluation quickly or have a massive month, that's when you're most vulnerable. The urge to push harder is strongest exactly when you should be pulling back and protecting gains. Livermore compared speculation to running a business.
Businessmen opening a shop or a store would not expect to make over 25% on their investment the first year. But to people who enter the speculative field, 25% is nothing. They are looking for 100%.
Unrealistic expectations lead to reckless behavior. He continued,
And their calculations are faulty. They fail to make speculation a business and run it on business principles.
a real business protects its capital. It doesn't bet everything on one customer or one deal. Livermore used this analogy.
A successful businessman extends credit to various customers, but would dislike to sell his entire output to one customer. The larger the number of customers, the more widely the risk is spread. Just so, a person engaged in the business of speculation should risk only a limited amount of capital on any one venture.
For futures traders, this means position sizing. Never risk your entire account on a single trade. Spread your risk across multiple setups over time, not all at once. Livermore told a story about a telegram from Palm Beach. He had a large short position. The market broke hard. He closed the trade and immediately wired his broker to send $1 million to his bank. The telegraph operator almost passed out. He said,
Thousands and thousands of messages have gone over the wire from brokers demanding margins from customers, but never before one like yours. I want to show it to the boys.
Why was this so rare? Because most speculators never withdraw their profits. Livermore explained,
The only time the average speculator can draw money from his brokerage account is when he has no position open or when he has an excessive equity. He won't draw it out when the markets are going against him because he needs all his capital for margin. He won't draw it out after closing a successful deal because he says to himself, next time I'll make twice as much.
So the money never leaves, and eventually it disappears. Livermore made a habit of withdrawing cash after every win.
For years after a successful deal was closed, I made it a habit to draw out cash. I used to draw it out at the rate of $200,000 or $300,000 a clip. It is a good policy. It has a psychological value.
Then he explained why.
Money in a broker's account or in a bank account is not the same as if you feel it in your own fingers once in a while. Then it means something. There is a sense of possession that makes you just a little bit less inclined to take headstrong chances of losing your gains.
Holding physical cash changes your psychology. It makes the money real. For futures traders, request that payout. Transfer profits to a separate account. Don't let your entire balance sit in your trading account waiting to be lost on the next trade. Livermore had a specific rule for when you're winning.
When a speculator is fortunate enough to double his original capital, he should at once draw out 1/2 of his profit to be set aside for reserve.
Double your account? Withdraw half immediately. He admitted he didn't always follow this.
This policy has been tremendously helpful to me on many occasions. I only regret that I have not observed it throughout my career. In some places, it would have smoothed the path.
Even Livermore, after decades of experience, regretted not protecting his profits more consistently. For prop traders, if you pass your evaluation and get funded, take payouts regularly. Don't let profits accumulate in the account thinking you'll withdraw later. Later often never comes. Livermore ended with a warning about brokers and overtrading.
Keep in mind that brokers sometimes innocently become the undoing of many speculators. Brokers are in the business to make commissions. They cannot make commissions unless customers trade. The more trade, the more commissions.
More trading benefits the broker, not necessarily you. He continued.
The speculator wants to trade, and the broker not only is willing, but too often encourages overtrading. The uninformed speculator regards the broker as his friend and is soon overtrading.
His final rule:
never make any trade unless you know you can do so with financial safety.
That's Chapter 4. Make money. Take money out. Feel it in your hands. And never risk more than you can afford to lose on a single trade. The only money that's real is the money you actually withdraw. Livermore made it a habit to withdraw cash after every winning trade. He understood that money in an account isn't real until you take it out. If you're serious about tracking your profits, managing risk, and actually keeping the money you make, check the links below. Platforms for charting, backtesting, journaling, automated analytics, psychology tools, trade sync, and prop firm funding for futures traders. If this helped, hit like and subscribe for Chapter 5. We'll cover Livermore's rules for pivotal points, knowing exactly when major moves are about to begin. Order filled, helping you see the game clearly so you don't get played. Educational only, not financial advice. Futures trading carries risk. Protect your capital.